People say vending machines and real estate, it's not passive, right? You got tenants to deal with, you got taxes to deal with. Obviously, if you could get a company to do it, but it's never really passive. What's important to understand the funds, understand the strategy that the fund manager is doing. And this is kind of what my channel focuses on. There's maybe a dozen S&P 500 covered call ETFs in the US. Some of them have 8% yield, some of them has 12%, some 14, some 16, some 30.
Welcome to the podcast. This is Mariusz Konieczny. Today we're talking passive income investing, and I'm talking with Adrian, the owner of a passive income investing YouTube channel. We're going to talk a lot about this topic, and hopefully we'll learn something. Adrian, thank you very much for joining me.
My pleasure. Thanks for having me.
So passive income investing, we all just want to, make money and sleep, right?
Of course, that's the dream,
yeah,
right?
Right. So how do you define passive income investing? Real estate, laundromats, dividends. Walk us through it.
Yeah, that's a really good question. So my channel focuses on passive income investing on the stock market. So obviously there's plenty of passive income sources, but my channel, what I do is just on the stock market, and that's it. Focusing on covered call strategies, covered call ETF. So obviously passive income, the goal is to generate passive income, right? But also that word passive, you could also see it as you're a passive income investor. So there's kind of two ways to see that name, passive income investing. So I would say you're an income investor passively. You're like you've heard, I'm sure, passive growth investor, where you're just buying the S&P 500 or index funds, and you're doing it passively. Well, it's the same thing, except you're an income oriented investor. So you're passive.
But is it truly passive? Because real estate is not really passive. You got to chase your tenants, and it's like a
truly
full-time
passive.
job.
This is where, when people say vending machines and real estate, it's not passive, right? You got tenants to deal with, you got taxes to deal with. Obviously, if you could get a company to do it, but it's never really passive. What my channel focuses on really is passive, right? So you're investing in these income-oriented covered call ETFs, and they're paying you every month or every week. Some of them pay weekly now. And it's 100% passive. You just have to buy them, stay invested in them, and you get the income passively. It just shows up in your account without doing any work whatsoever. So this is 100% pure passive income, just like dividend stocks, right? When you're buying a dividend stock, you're getting that dividend every quarter. That's pure passive income. It's the company, it's a share of the company's profits, right? But you don't work for the company, you're part owner of the company. So it's kind of the same thing. It's just the investment vehicle is different. I consider dividend stocks and what I do, covered call ETFs, covered call strategies, separate, a bit different. You got dividend stocks, which is dividend investing, right? You're investing in stocks that have a dividend, single securities, single stocks. You're picking and choosing, or you're buying a dividend ETF like SCHD or the Vanguard one, VIG, VYM, right? There's plenty of dividend ETFs. I consider that dividend investing. What I do is a little bit more, it's really income oriented. There could be dividend stocks there as well, but the main strategy is the covered call strategy, which is a very basic option strategy, which, just like dividend investing, you could do yourself, right? You could pick your own dividend stocks, but you could write your own call options as well. Or you could just get the ETFs, and the fund managers do that for you. So I go with the ETF route. I don't write my own options.
Okay, but now, so talking about the covered calls.
Yeah.
So the basic is you can buy a call, and a call gives you the right to buy whatever at a particular price. And then you have puts, you have the right to sell. But when we're talking about calls, people always think, well, I'm buying the call. But what you're doing is you're selling the call, right?
Correct. The ETFs are actually selling the calls. Like I said, you could do it yourself. You could buy Apple, you could buy Nvidia, and sell your own calls to generate income. But that's what the ETFs do. They sell the call. Sometimes they sell puts too, but the main strategy is they're the ones selling the options, and they're taking in the premiums.
Okay, so what kind of yields can people expect while investing in those kinds of ETFs?
It depends. The range is massive. It really depends how much, I like to say how aggressive the covered call strategy is, or the more calls you write, the more calls you do. Obviously, the more premiums you take in, so the higher the yields are. But the flip side is, of course, when you're selling more calls or doing more, you're giving up more upside. So when you're writing covered calls or selling covered calls, same thing. In the US, they typically say write. In Canada, we don't really say that. We say sell. But when you're selling call options, you're giving up, or you're capping, or you're limiting, there's many ways of saying it, a portion of your upside. So you could have one single stock with covered calls, an S&P 500 with covered calls, Nasdaq 100, you could have pretty much almost covered calls on Bitcoin now. There's so many new products that have recently launched in the last couple of years. You could have covered call ETFs for any asset, even fixed income. TLT, there's TLT, which is the 20-year treasury. There's covered calls on everything now. But essentially, when you're buying a covered call ETF, you're still investing in the asset. So if it's a S&P 500 with covered calls, you're still investing in the S&P 500. It's very important. People need to understand that you're not investing in some sort of abstract thing. You're investing in the S&P, in the Nasdaq, in Nvidia stock, in Tesla stock, whatever the underlying asset is. That's what you're investing in. That is your primary driver of risk and return. Okay, and then the fund manager is selling covered calls typically on that
To enhance
asset.
the return, right?
Hence the premiums and the yield. I wouldn't say return. People mix up yield and return all the time. Your yield is your yield. Your total return is everything together, right? Is yield plus your capital together.
But now, obviously, the best case scenario in such a case, what you're hoping for is that you sell the call and then it expires, and then you don't
Exactly.
have to get rid of you don't have to get rid of the underlying asset, right?
Yeah. So that's something you don't have to worry about if the ETF is doing it. If you're doing it yourself, obviously you're going to lose that stock if the strike price gets hit. But this is where there's differences between the cover call strategies. I'll give you an example. I'll keep it really easy. There's maybe a dozen S&P 500 cover call ETFs in the US. Some of them have 8% yield, some of them has 12%, some 14, some 16, some 30. Typically, the general rule of thumb, the higher the yield is, the more premiums they're taking in because they're giving up more upside. So if you are really scared, if you're bearish, for example, if you really don't think the S&P 500 is going to go up, you're going to write more covered calls. And if you're more skeptical, you're going to tend to go with an S&P 500 covered call ETF that writes more covered calls. So you'll get higher yield, but if the S&P goes up, you're not going to capture a lot of that upside. If you're more optimistic, you think the S&P is going to go up, and you're okay with a smaller yield, with maybe an 8% yield, you're going to go with a fund that has less yield, which means you're going to capture more of the growth of the S&P 500, right? So it's all about that balance. It's up to you to decide how much you want to give up. And the general rule of thumb, the higher the yield, the more you're giving up, right? Because to take in more premiums, you have to write more calls or cover more of the portfolio. So there's really two factors when it comes to determining how much upside you're giving up. It's the moneyness of the calls and how much they're writing on the portfolio. Are they writing cover calls on 100% of the portfolio, 50% of the portfolio, 25%? That's the easiest one, the portfolio coverage percentage. The moneyness of the options, a little bit more difficult to understand, but I'll give you a super quick example if you want me to go through it. You have, let's say a stock's $100. You sell the call at $105 strike price. That's a 5% out of the money call. So next month, typically they expire after 30 days. The contract is 30 days. So after 30 days, if that stock stays at 100, it goes to 101, 102, 103, 104, even 105, you're good. It expires worthless. But if it goes to 106, 7, 8, you're basically giving up everything after 105. So that's not a very aggressive call, 5% out of the money for 1 month. But you could do a 1% out of the money. You could write the call at 101. When you're doing that, you're giving up everything after 101. So you only have $1 of growth, right?
But then you're collecting but then you're collecting more money for the
You're
for the
collecting
call.
more premium, of course. And then there's at the money, where if it's 100, you could sell it at 100. That you're maximizing, you're getting a big premium, but essentially you're forfeiting all the upside after 100.
So give me an example of three scenarios. You sell it at a strike price of, let's say, 100, 100, 105, or some other example.
Yeah.
And what kind of premium can you collect for these scenarios? And I know it
So
differs from stock to stock.
the premium that you collect depends on the volatility of the asset. The higher the volatility is of the asset, the more premium you collect. Think of it like an insurance company, right? You're collecting, an insurance company collects premiums if they're offering automobile insurance. Now, if you're a 21-year-old, you just got your license and you bought a Toyota Supra, well, your premium is going to be very high because it's very risky for the insurance company. But if it's, for example, a 65-year-old woman with an immaculate driving record that buys a Toyota Yaris or Toyota Corolla, their premium is going to be much lower, right? The volatility, the risk is lower. So it really depends on the stock and the asset. So Tesla, for example, if you're just doing covered calls on Tesla or strategy stock or typically tech stocks like Palantir, the premiums are very high. They're very rich because those stocks tend to be more volatile. But if you're writing covered calls on Berkshire Hathaway or Microsoft, more boring Procter and Gamble, more boring stocks, or even like TLT in fixed income, the premiums are much lower because there's not much volatility. So the premiums you take in really has to do with the volatility of the stock.
Okay, if somebody has $100,000 and
Yeah.
wants to engage in this kind of strategy, what kind of ranges of, like, how much can a person generate per year in income using a strategy like this on $100,000? Because we're
Well,
talking about paying bills with this and living on it.
So it really, there's a massive range. It could be anywhere from like 4% to 100%. Right? For example, now one of the most volatile stocks right now is Michael Saylor's strategy stock, MSTR, because it's like leverage Bitcoin, and Bitcoin is very volatile itself, so it's crazy volatility. So there's many now. There's maybe 5 or 6. They just keep coming out because there's so much demand. Where it's an ETF just holds MSTR and they write covered calls on it. MSTY from YieldMax was the first one, and I think it has 4 billion now. The yield, this is what people need to understand. It changes dramatically every month because the volatility changes.
Right.
So you can't rely on, maybe the yield is 60% now. Maybe next month the dividend or distribution or the premiums are going to be much less because volatility is down. So if you have 100, let's say you like the idea of passive income, you like the strategy, what you really need to decide first is, what asset am I going to invest in? Because that is going to be your determinant of, yes, your yield, but also your risk, right? So I like, this is me, this is not financial advice, it's me personally. My portfolio, for example, my core positions, my cornerstone foundational positions are S&P 500, NASDAQ 100 indexes with covered calls, right? So the yield you could generate doing covered calls on the S&P 500, well, the yield is typically what the VIX is, right? The VIX is the volatility measure so it's typical of the S&P. So it's typically 15%. So S&P 500 covered call ETFs, you typically have a range of, I would say, 8 to 14% yield generally. But the yields are, I'm sorry?
Per year?
Per year. Yeah, when I say yield, that I typically, it's always annual. So there's plenty of 8, 10, 12, 14% S&P 500 covered call ETF. So you're still buying the S&P 500, but the ETF is writing covered calls on the S&P, so you're giving up a portion of the upside of the S&P, but you'll get fairly consistent monthly income because the VIX is kind of consistent. So some fund managers will typically keep the dividends, the monthly distributions very consistent because they know people are living off of it. Some people, they give a monthly dividend, monthly distribution. Some it's a weekly distribution and it varies every week because they give out everything that they earn. And from week to week to week to week, the volatility of the S&P 500 is different. So it's important to understand the funds, understand the strategy that the fund manager is doing. And this is kind of what my channel focuses on. I try to inform people of the different strategies. I have the fund managers on the channel. I ask them questions. I really want to dig deep into what is the cover call strategy you're doing on this one versus this one versus this one, so people have a good idea of which ones are best for you to include in your personal portfolio depending on your needs, right? Is it super
Great.
boring consistent income, or are you willing to take higher risk and you want to invest in strategy and you know what I mean? So it really depends on the goal of the investor.
Okay. And now going back to just regular dividend paying stocks,
Yeah.
there could be ranges. You could get a less than 1% dividend yield, and you could get closer to 10%.
Yeah.
So what does it depend on in regular stocks, whether you're on the lower range or higher range? The type of companies.
Before I discovered covered call strategies and covered call ETFs, I personally invested in many single dividend stocks with 6, 7, 8% dividend, right? And then of course you have some that have 1 or 2 or 3%. You know, the banks typically have like 2%, 3%, 4%. What I've discovered is that on a single stock, on just one company, if the dividend is 6, 7, 8, 9, the higher the yield is, the riskier it is to be cut. If something goes wrong, you have a high chance of the one that's 6, 7, 8, 9, 10 to be reduced or cut than the one that 1% or 2%. And I actually experienced this in 2020 during COVID. During COVID, I had my portfolio was a mishmash of single dividend stocks, single REIT stocks, real estate stocks. And during that time, many of them, and I typically went for the ones that were 6, 7, 8, 9, 10. Many of them reduced their dividend by half, canceled their dividend altogether. So to me, it's a really risky strategy if you're going with
Because then the stock goes down and you lose more on the
then the stock goes down as
yeah.
well. But what I discovered is the covered call ETFs, they didn't reduce their distributions. Actually, some of them actually increase their distributions because when there's a crash, volatility spikes, which means they're taking in more premiums. So that's when I started really understanding covered call strategies, covered call ETFs, and I transitioned everything into those strategies once I saw how they behaved during a crash. So, by the way, when you typically add a covered call strategy to anything, you're actually lowering the risk. So if you have S&P versus just Vanguard or BlackRock S&P 500 versus S&P 500 with covered calls, the one with the covered calls has lower risk than just holding the S&P, because by writing call options, you're reducing your volatility.
Okay.
Yeah.
In general, if a person wants to support a family on a $100,000 per year income, and not go too crazy with the risk, what size of a portfolio on average would they have to generate that income and employ your strategy?
Well, I would say fairly conservatively, you could generate easily on the US market, even in the Canadian market, between 10 and 15% yield with a well-diversified portfolio, for example, that's majority in indexes like S&P, like very popular S&P 500 cover call ETFs, NASDAQ 100 cover call ETFs, which in my personal opinion are the best assets, best and easiest ways to invest in the stock market, the safest ways, right? You have instant diversification, automatic rebalancing, blah 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 blah. Your audience members, I'm sure they know all the benefits of index funds. I love index funds, and I love those two indexes because it's the American stock market, the American economy, the best in the world, the best performing in the world. If you just get an S&P 500 covered call ETF or a Nasdaq 100 covered call ETF, you could easily generate between on average 12 to 15% yield.
So
right?
you just buy those ETFs
You just buy those
like a stock,
like a
with
stock,
ticker
they're
symbol.
ETFs. You hold them every month or every week, you'll get a dividend payment. Now, of course, you have to remember that dividend payment, that distribution, comes out of the net asset value of the fund. So when you look at the stock charts of these funds versus, for example, a regular S&P 500, they'll look completely different, even though you're investing in the same thing. Because, so a Vanguard S&P 500, you look at the 10-year, 1-year, typically 5-year stock chart, you'll just see a rocket ship going up, right? NASDAQ. But with these, you'll typically see flat. But that's because they're giving you that income
it's
every
getting
month.
paid out, right?
It's coming out of the net asset value of the stock price. So it's important to look at the total returns, not the stock price return, not the stock chart of these ETFs. I always like to do the total return versus the S&P, right? S&P 500 covered call ETF. What is the performance versus the actual S&P 500? And what you'll notice is some strategies perform better. Some covered call strategies perform better than others, but both investors are still investing in the S&P, so the actual total returns and stock and return charts kind of follow each other, right?
Okay. And what are your favorite ticker symbols for those ETFs?
Okay, so I'm assuming. So personally, I invest in the Canadian stock market, but I'm aware of both markets. The U.S. stock. I'm assuming your viewers are mostly in the U.S., right? So we'll talk about the U.S. stock market. So again, it's critical to understand that you have to ensure if you're wanting to invest in this stuff, you understand what you're investing in, right? So if you want to keep it simple, if you like the S&P 500 index funds, you could invest in an S&P 500 covered call ETF. And I think the top 3 S&P 500 covered call ETFs right now on the US market is GPIX. GPIX is from Goldman Sachs. That one has an 8% yield typically. Monthly payout, very consistent monthly payout, approximately 8% yield. That is holding up fairly well or performing very similarly to just the S&P 500. A bit less, of course, because you have to remember, if you're giving up upside, a little bit of upside, and the S&P is going up all the time over time, you're not going to perform as much. But the performance is pretty good. The yield is an 8%, and you're investing in the S&P 500, and the fee is actually pretty low on that one as well. It's only 35 basis points. So GPIX, a good basic one, my opinion. Another really good one and popular one as well, basic one as well, is SPY from NEOS. That one has an approximate 12% yield. Again, very consistent monthly distributions. And then there's also, there's so many of them. I'll give you a third one. T-SPY from Tap Alpha is another really cool one, which has about 14% yield. And those guys do daily covered calls. They're called 0 DTE covered calls. So 0 DTE is relatively new. It's 0 days to expiry, which means you could write a covered call, and this is only available for the S&P 500, the Nasdaq 100, and the Russell 2000 for now. You could do a daily call option or sell a daily call option on the index. So that's what T-SPY does. So you're 8% yield, 12%, 14%. You're investing in the S&P 500. You're giving up a portion of the upside for income. So if you're an investor whose income is the priority and you're willing to give up a little bit of upside and a little bit of performance probably as well, versus just holding the S&P that only has 1% yield, 1.1, because it has some dividend stocks in there, but you're only getting about 1% yield. You could get an 8, 12, or 14, and some of them have much higher ones as well.
Wow, thank you very much. That was very, very educational. That's why I love doing these interviews. So if people want to learn more about this strategy, where can they find you?
YouTube channel, Passive Income Investing. So I focus on both the Canadian stock market and the US market, but my focus is the covered call ETFs, right? So I unveil, for example, my portfolio every month there. I have a monthly series separated into episodes now because there's so many new covered call ETFs where I have a Canadian episode and a US episode where I basically review the entire covered call ETF landscape on the US market, on the Canadian market. There's so many of them that I can't cover all of them. I actually tend to stick with the S&P 500 and NASDAQ 100 ones. So those three, I basically cover them every month, as well as another 10 S&P and other the NASDAQ ones as well, just because I feel they make good core positions in any portfolio, just like an S&P is a core position in a growth portfolio. It's the same thing, right? So I have a lot of fund managers on to talk about their strategy, what they do different from other fund managers. So my channel is really an educational, keeping you up to date on the covered call ETF landscape. That's the goal of my channel.
All right, well, perfect. Thank you for doing this.
Appreciate it. Yeah, no problem. Anytime.